channel. I'm Doris. I'm here to share with you about today's stock account update. Today my stock account has lost $1,530. Today US stocks closed higher and focused on earnings and Fed policy outlook. Jpmorgan Chase CEO said the Fed is getting slightly out of control about inflation. In my account today I made a total loss of less than 2%. Now the net asset of my account is 75,513.89. Today S&P 500 decreased for 2.55% during the market time, and in the post-market it rose for 0.37%. DRV decreased for 2.81% and rose for 1.32% in the post-market. In the market in general, Dow Jones Industrial Average rose for 0.33%, Nasdaq Composite rose for 0.72%, and S&P 500 Index rose for 0.53%. All three major indexes showed a little recovery from yesterday's decrease. Today, the semiconductors showed a decrease of 4.94%. The market focused on Nvidia's earnings report and the Fed's insistence on raising interest rates to curb inflation. U.S. jobless claims last week showed labor market conditions remain tight. Nvidia closed up more than 14% and its shares hit a new 10-month high, pushing the Nasdaq up. The company beat expected for Q4 results and Q1 revenue guidance for fiscal 2023. The company's AI, including data center revenue, exceeded $15 billion, a record high. Markets are still reviewing the minutes of the Fed monetary policy meeting released on Wednesday. The minutes show that central bank members are determined to continue raising interest rates to fight inflation. FOMC minutes show inflation still well above the Fed's 2% target, and the labor market remains very tight, leading to continued upward pressure on wages and prices. Bill Adams, chief economist at United Credit Bank, said the Fed is determined to send some slack signals to the labor market to ensure that inflation is not entrenched at its current high levels. By mid-2023, year-over-year CPI inflation is likely to slow to levels below the federal funds rates, but if inflation unexpectedly rises again or unemployment falls further, the Fed could raise interest rates more than we forecast. On the economic side, the Labor Department reported that the initial claims of unemployment benefits in the week ended February 18 stood at 192,000, compared with 200,000 expected and 194,000 previously. Continuing claims for unemployment benefits for the week ended February 11th was 1.654 million person, compared with 1.7 million expected, versus 1.696 million last week. Analysts noted that this week's report was highly correlated with the Bureau of Labor Statistics non-farm survey data, so given that the number is still below 200,000, it means that there will be a good number in the next month's employment report. The chance of a 50 basis point rate hike at the next Fed meeting is around 20%. The terminal interest rate is expected to be around 5.35%. At the next Fed meeting, they will revise their final interest rate forecast based on the central trend. Another data showed seasonally adjusted real GDP grew 2.7% in the fourth quarter from a year earlier, compared with 2.9% expected and 2.9% last. The fourth quarter real GDP report is not a very good data, but the market may see it as a signal of a shift to economic growth in the first quarter of 2023, analysts said. Other data showed the Chicago Fed's National Activity Index for the January at 0.23, up from negative 0.25 expected and 0.49 expected last. The core PCE price index was revised to 4.3%, 3.9% expected and 3.9% last. Jpmorgan Chase CEO, the Fed is getting slightly out of control about inflation. In a media conversation on Thursday, Jpmorgan CEO Jamie Dimon said, I respect Fed Chairman Colin Powell, but the fact that we're having lost a little control of inflation. Last week, the U.S. released its January CPI and PPI inflation data. Although the year-on-year growth of the relevant data continued to slow, but the significantly higher than expected month-on-month back up or accelerated among them. The service inflation in the CPI data was the highest in more than 40 years, and the PPI data showed a month-on-month increase of 0.7%, the largest since June last year. Last day, the Fed released the minutes of its FOMC meeting, which ended in early February. While the minutes agreed that there were recent signs that the cumulative effect of monetary tightening had begun is raising pressure on inflation, several officials said inadequate policy constraints could prevent lower inflation and that inflation expectations could be decoupling. And Fed officials are more concerned about inflation than they are in a recession. Fed officials don't expect U.S. inflation to fall to 2% until 2025. Dimon noted that controlling inflation is still the Fed's ongoing work. He expects interest rates to remain high for longer because it could take some time to reach the Fed's 2% inflation target. Last month, Dimon said there was a 50% chance that the Fed's benchmark rate increases to around 5% is correct, and a 50% chance that Fed will have to raise interest rates to 6%. He expects a 5% rate hike may not be enough, and the Fed may need to raise interest rates to levels more than currently expected. The Fed had been a bit slow and is not catching up, but Dimon said he favored a moratorium to understand the full impact of last year's hike, and did not think it hurt to wait 3 to 6 months. On the same day, Dimon was more optimistic about the U.S. economy than before. Seeing the strength was encouraging. The U.S. economy in good shape right now. Consumers have a lot of money. They're consuming it. There are a lot of jobs. That is what it looks like today. There was something terrible before us. We all know that there is always uncertainty. That's a normal thing to do. The comments on the U.S. economy stand in sharp contrast to Dimon's remark in October. At the time, he said the U.S. economy could fall into recession within 6 to 9 months. He also said in December that high inflation is eroding consumer trust, which will send the economy into recession this year. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.